Most people with a pension make the same investing mistake, and it quietly costs them $180,000 to $340,000 over a 20-year retirement. Here's the thing. They're not doing anything wrong on purpose. They're saving, they're being responsible, but they're stacking money into accounts in the wrong order. And because of that, the IRS takes a cut they never had to take. A retired couple, both age 64, pension income of $3,800 a month, sitting on a $420,000 traditional 401k balance, they feel fine, comfortable even. But at age 73, something happens that nobody warned them about. Their required minimum distributions, forced IRS withdrawals, kick in at roughly $16,200 per year. That pushes their combined income to $62,000. Now, 85% of their Social Security becomes taxable. Their Medicare Part B premium jumps by $594 a year because of IRMA, the income-related Medicare surcharge, and their effective tax rate climbs from 12% to 22%. They didn't earn more, they didn't spend more. The order they saved in created a tax trap they can never fully escape. With a pension already covering your baseline, every dollar you invest goes further, but only if it goes into the right account in the right order at the right time. Here's what we're walking through today. Number 1, why having a pension completely changes which accounts you should prioritize first. Number 2, the exact investment order that protects your money from unnecessary taxes in retirement. Number 3, the one account most pension holders completely ignore and why it could be the most powerful tool you have. And at the end, I'll show you the one decision most people make at age 62 that locks them into higher taxes for the rest of their life and how to avoid it. Number 1, why a pension changes everything. Let's start here because this is the part most financial content gets completely wrong. If you don't have a pension, the standard investing advice is contribute to your 401k first, get the employer match, then maybe a Roth IRA, then taxable accounts. That framework works fine for people without guaranteed income, but you have a pension, and that changes the math in a fundamental way. Here's why. Your pension is already guaranteed ordinary income. Every month, whether the market is up or down, that check arrives. Let's say your pension pays $2,800 a month. That's $33,600 a year of taxable income before you touch a single investment account. Now, if you also have a traditional 401k, where every withdrawal is taxed as ordinary income, you're stacking taxable dollars on top of taxable dollars. An example. Imagine a change teacher, age 63, with a state pension of $3,200 per month, $38,400 a year per year. She also has $380,000 in a traditional 403b plan. When she starts withdrawing $1,500 a month from that 403b, her total income jumps to $56,400. At that level, 85% of her Social Security, let's say $1,900 a month, becomes taxable. That's an extra $19,380 per year in taxable income she wasn't fully accounting for. Her federal tax bill increases by roughly $4,200 annually compared to what it would have been with a smarter account mix. That's not a catastrophic mistake, but over 20 years, that's $84,000 in extra taxes she didn't have to pay. So here's the takeaway from Section 1. Your pension is already filling your lower tax brackets. Every additional dollar you pull from a traditional 401k or IRA is taxed at your highest rate, not your average rate, which means the order you invest in, and later the order you withdraw from, matters far more for pension holders than for anyone else. If you are finding this video helpful, please show some free love and support by hitting the like button and let me know in the comments from which job you are retiring and what is your age right now. I read every single comment, and I will try my best to answer if you have any questions. Number 2, the investment order, step by step. All right, so what's the right order? Let me walk you through this clearly. There are 4 account types available to most working Americans, and if you have a pension, here's the priority order I want you to think about. Step 1. Capture the full employer 401k match, always. If your employer matches your 401k contributions, say 3% of your salary, that's an instant 100% return on that money. Nothing beats it. Even if you plan to convert or withdraw from that 401k later, you still capture the match first. This is non-negotiable. Example, if you earn $75,000 and your employer matches 3%, that's $2,250 in free money every year. Over 10 years, with modest 6% growth, that match alone becomes roughly $29,700. You never give that up. Step 2. Max out your HSA if you're eligible. This is the account most pension holders ignore, and it might be the most powerful one available to you. HSA stands for Health Savings Account, and it has what's called a triple tax advantage, meaning contributions go in tax-free, they grow tax-free, and withdrawals for qualified medical expenses come out tax-free. No other account in the U.S. tax code does all three. In 2024, if you're 55 or older and enrolled in a qualifying high-deductible health plan, you can contribute up to $4,650 as an individual or $8,300 as a family, plus a $1,000 catch-up contribution if you're 55 or older. That's $9,300 per year going in completely tax-free. Here's the strategic move. Don't spend the HSA money now. Pay your current medical bills out of pocket if you can afford it. Let the HSA invest and grow. Then, after age 65, you can withdraw for any reason, not just medical expenses. If it's for non-medical use, you'll pay ordinary income tax on it, just like a traditional IRA. But if it's for medical expenses, Medicare premiums, dental, vision, long-term care, it comes out completely tax-free. According to Fidelity's 2023 healthcare cost estimate, the average 65-year-old couple will spend approximately $315,000 on healthcare in retirement. That's $315,000 where your HSA withdrawals could be completely tax-free. With a pension covering your living expenses, this account becomes a tax-free medical reserve, and that is extraordinarily valuable. Step 3. Fund a Roth IRA or Roth 401k before adding more to traditional accounts. Here's where pension holders get the biggest advantage most of them don't realize they have. Because your pension covers your basic living expenses, you don't need to draw from your retirement accounts right away in early retirement. That means you have years, potentially 10 to 15 years, where you can let a Roth IRA grow completely tax-free. A Roth IRA works like this. You contribute after-tax dollars today, the money grows tax-free, and every qualified withdrawal in retirement is completely tax-free. No RMDs, no forced withdrawals at age 73. The IRS never touches it again. In 2024, the Roth IRA contribution limit is $7,000 per year if you're under 50, and $8,000 if you're 50 or older. That's the catch-up contribution. To contribute directly, your income must be below $146,000 as a single filer or $230,000 as a married couple filing jointly. If your income is above those limits, which is possible if your pension plus salary puts you over, there's a strategy called the backdoor Roth IRA that allows you to contribute indirectly. It's legal, it's IRS approved, and it's worth knowing about if you're a higher earner with a pension. Imagine a firefighter age 55 with a pension of $4,100 a month and a salary of $48,000 still coming in. He maxes out his Roth 401k at work, $30,500 in 2024, including the $7,500 catch-up contribution, instead of the traditional 401k. Over 10 years, assuming 7% average annual growth, that Roth account grows to approximately $421,000. Every dollar of that $421,000 comes out in retirement completely tax-free. His pension covers expenses, his Roth covers everything else, with zero IRS interference. That's the pension advantage. Your guaranteed income lets your Roth breathe and grow without you needing to touch it. Step 4. Then add to your traditional 401k beyond the match. Only after steps 1 through 3 are maxed should you go back and add more to your traditional 401k or 403b. In 2024, the total 401k contribution limit is $23,000 with a $7,500 catch-up for those 50 or older, bringing it to $30,500. Traditional contributions reduce your taxable income today. If you're still working and in the 22 or 24% tax bracket, that deduction has real value right now. But remember, that money will be taxed when you withdraw it in retirement. And if your pension is already filling your lower brackets, those withdrawals will hit you at 22 or higher percent. The traditional 401k is still worth using, but it's step 4, not step 1 for pension holders. Step 5, taxable brokerage account, last. If you've maxed everything above and still have money to invest, and some pension holders do, a regular taxable brokerage account is the final layer. No contribution limits, no withdrawal rules, but no special tax advantages either. The one tax benefit here, long-term capital gains. If you hold investments for more than 1 year, your gains are taxed at 0%, 15%, or 20%, depending on your income. For a married couple with income under $94,050 in 2024, that rate is zero. The IRS takes nothing on those gains. With a pension covering income, some retirees can strategically position themselves to pay 0% on capital gains for years. That's a powerful benefit, and most people have no idea it's available to them. Now, before we get to the action steps, I want to show you something that changes everything we just talked about. Because most people with a pension do steps 1 through 5 fairly well. They capture the match, they save consistently, they feel organized. But there's a decision most people make somewhere between age 60 and 65 that quietly unravels years of smart saving. This next part is the most important thing in this entire video. Number 3, the withdrawal order, the mistake that costs 6 figures. You've saved well. Your pension is steady. Now retirement is here, and you start drawing money. Most people do this in the most intuitive order. They take the pension, maybe a little Social Security, and then, if they need more, they pull from whatever account is biggest. Usually the traditional 401k or 403b. That feels logical, but it is, in many cases, the most expensive order possible. Here's why. The right withdrawal order for pension holders in most situations looks like this. First, live on your pension and delay Social Security as long as possible, ideally until age 70. For every year you delay Social Security past your full retirement age, which is 67 for anyone born after 1960, your benefit increases by 8% per year. From age 67 to 70, that's a 24% permanent increase in your monthly check. For someone entitled to $2,200 at age 67, waiting until 70 means $2,728 per month, every month for life, adjusted for inflation. That difference over a 20-year retirement is $127,680. Second, during the years between retirement and age 70, what financial planners call the golden window, use that time to do Roth conversions from your traditional 401k or IRA. A Roth conversion means you take money from your traditional account, pay the taxes on it now, and move it into a Roth account. Why would you do this voluntarily? Because the years between roughly age 60 and 72, before RMDs start at 73, and before Social Security is fully maximized, are often the lowest income years of your retirement. Your tax brackets are lower, your Medicare premiums haven't spiked yet, and every dollar you convert now is a dollar that will never be subject to RMDs. Imagine a retired couple, both age 63. Their pension income is $52,000 combined. They're in the 22% federal bracket. They do a $30,000 Roth conversion per year for 8 years, paying roughly $6,600 in taxes annually. But at age 73, instead of facing RMDs of $18,000 or more per year from a large traditional IRA, their traditional IRA balance is $240,000 smaller. Their RMDs drop by nearly $9,000 per year. Their Social Security taxation decreases. Their Medicare premiums stay lower. The tax savings over 15 years of retirement estimated at $85,000 to $140,000, depending on their bracket. They paid $52,800 in conversion taxes to save more than double that. That's the math. Third, when you do need to withdraw beyond your pension and Social Security, pull from taxable brokerage accounts first, especially if you're in the 0% long-term capital gains bracket. Tax-free gains first. Fourth, traditional 401k and IRA withdrawals come next, strategically, to stay within lower brackets. Fifth, Roth IRA last. Let it grow as long as possible. Use it only when needed, or pass it to heirs completely tax-free. This 5-step-by-step withdrawal order is best for pension holders. Now, let's move on to the fourth point. Number 4, the one account pension holders almost always ignore. We talked about the HSA in the investment order section, but I want to come back to it here because for pension holders specifically, this account is dramatically underutilized. According to a 2023 report from Devenir Research, the average HSA balance among accounts that are actually being invested, not just used for current expenses, is $16,397. That's a fraction of what most people could accumulate if they treated the HSA like a retirement account instead of a medical spending account. Here's the practical version. If you're 55 right now, still working and eligible for an HSA, and you contribute $9,300 per year for 10 years and invest that money at a 6% average return, your HSA balance at age 65 would be approximately $122,000. Every dollar of that $122,000 used for qualified medical expenses comes out completely tax-free. No income tax, no capital gains tax, nothing. Your pension covers your lifestyle. Your HSA covers your health care. Your Roth covers everything else. That combination, pension plus HSA plus Roth, is one of the most tax-efficient retirement structures available to any American worker, and almost nobody with a pension is intentionally building it. Don't let this be another video you watched and forgot by tomorrow. Here are the exact practical steps you can take this week. Step 1. Write down your pension income in retirement. Estimate monthly, then annual. That number is your foundation. Everything else gets built around it. Step 2. Log into your employer benefits portal and check whether you have access to a Roth 401k option, not just traditional. If you do, consider shifting future contributions to Roth. You can even split, some traditional, some Roth, to balance current tax savings with future tax freedom. Step 3. Check your HSA eligibility. If you're enrolled in a high-deductible health plan, open an HSA today if you haven't. Start investing the contributions. Don't just let them sit in cash. Fidelity, Lively, and Health Equity all offer investment options inside HSAs. Step 4. Pull up your Social Security statement at ssa.gov. Look at what your benefit would be at age 62, at 67, and at 70. Write down the difference. If delaying from 67 to 70 adds $400 or more per month to your check, and for most people it does, that 24% permanent increase may be worth more than any investment you make this year. Step 5. If you're within 10 years of retirement, talk to a CPA or fee-only financial advisor about a Roth conversion strategy. Ask them specifically, given my pension income, what's the optimal amount to convert each year before my RMDs begin? That one conversation could save you more than $100,000 in taxes over a 20-year retirement. Before you go, I want to hear from you. What is your age and whether you have a pension plus a 401k or a pension only? I read every comment, and I'll try to give you a more specific answer based on your situation. If this was helpful, and I hope it was, please subscribe. And if you want to know about the 4-part formula for having a happy and fulfilling retirement, that video is right here. It's one of the most important videos that every retiree must watch. Take care of yourself, and I'll see you in the next one.